Okay, good morning, guys. I'm so glad that you are joining me. Um, so let's start. I'm Tosca van Maurik. Let me just get it right here. And I am one of your lecturers for your consoles modules. Welcome and thank you so much for joining me. I have said in the comments at this stage, when I'm sharing a screen, I cannot see any hands and I can also not see any comments. But if you want to comment on something or have a question on something, please feel free to write or type out your comment, and then I will, after the class, I will quickly go through all the questions that is posted there. So let's see on the agenda today, we are going to do case study 8 in the TAT 106 4864 TAT letter. So in this case study, we're going to do question 1 part A, question 1 part B, and then also question 2 part A. The rest are not that difficult, so I'm sure that you will be able to do it on yourself. But if not, please note that we are always here for you. We try to answer our emails within 24 hours, so please let me know. So let's jump in. I hope everybody has your TAT letter with you and in front of you, and hopefully you have worked through it. If you not have worked through it, maybe just have read something about that. But let's see. So background to this question, on 1 August 2015, Horses Limited have purchased 80,000 of the 100,000 shares in Saddle for 1.58 million. They are based in the Northern Cape. Helmet Limited held the other 20,000 shares, but Horse does have the only control. All assets and liabilities were to be fairly held, and then no additional assets and liabilities or contingent liabilities were identified. The year end is 30 June, and then we give you the extract of the balances on 30 June 2016. So there you see a list of all the current and non-current assets, the revenue, the profit for the year. Then also in the additional information, it says that normal tax rates are applicable, and very important, non-controlling interests are material. So if you just look at this, there is nothing too much given. The main thing given was the list of all the assets and liabilities, or no summary of the list. So this actually screams IFRS 12. Let's see what was required. Provide the investment in Saddle Limited note to the consolidated financial statements of the Horse Limited Group for the year ending in accordance with IFRS 12. So what is important here with the required? It's a new subsidiary, new investment. We have to do the note in terms of IFRS 12. There's no mention of IAS 7. So don't jump into your cash flow question or statement of cash flow to do that note, because it's an easy note to do, and I know you can do that note, but we haven't said anything about the cash flow. And then what does IFRS 12 say? If you are unsure in the exam, or if you have a blank or whatever happened, remember you do have your IFRS 12 with you, so open it. So there's an extract of what IFRS 12 says. IFRS 12 says you have to list the name of the subsidiary, the principal place of business, the proportionate ownership of the non-controlling interest, also the voting right if that differ from the ownership, the profit or loss allocated to your non-controlling interest, any accumulated non-controlling interests, and then the summarized information. As you can see, it also says there, please see paragraph B10. So let's go to B10. What does B10 tells us? For each subsidiary that has non-controlling interests that have material. So what did the scenario states? The scenario states that Helmet was material to the subsidiary. Okay, so there's our key. What was me also disclosed? The dividends paid, and then your summarized information. Then the standard tells us what is the example of the summarized informations. It is your current assets, your non-current assets, current liabilities, non-current liabilities, revenue, and any profit or loss. If there was some intergroup transactions, please note that B11 tells us that the summarized information that must be disclosed as in B10 must be before any intercompany eliminations. Any questions so far? Everybody with me? Everybody can see what I'm doing? If not, please take your mute off and quickly tell me. Then I can try to make a plan. Okay, so I don't hear anything. So for me now, it means that we are all on the same page. So let's quickly see what the solution looks like. It's exactly what is listed as this must be disclosed in your financial statements or in your IFRS handbooks. So there's the name of the subsidiary, the principal place of business, the proportion of ownership and voting right. In this case, it's exactly the same portion. There's the profit allocated to your NCI, and then the summarized information as given. Right at the bottom, there's also the dividends paid to the non-controlling IFRS interests that IFRS 12 B10, paragraph B10 will tell us. Okay, guys, any questions on Horses Limited? It's a fairly easy question. As you can see, there's 7 marks that you can really jot down from your IFRS handbooks. And remember, it's a fairly new standard. So what does that tell you? Okay, so just an extra side note, if the subsidiary was not a subsidiary but an associate, there are some additional requirements. And then again, go to your IFRS handbooks, go to IFRS 12 and paragraph 21 and B16 will then have the requirements for the associates. So my exam tips for now is go and flag this in your handbook for easy reference. It's easy marks to score in level 1 and level 2. And as I said previously, it is a fairly new standard. So we like to ask this kind of questions in a test and the exam. Okay, if there are any questions that you'd like to ask? Nothing. Let's go then on to Fedora Limited. So this is now level part 2. This is only for the level 2 guys. And let's see. So on 1 April 2016, Fedora has acquired a 90% controlling interest in Haiti Limited. And the functional currency of Haiti is the US dollars. Company have a year end of 30 June. All assets and liabilities are deemed to be fair except for a plant with a carrying amount of $53,000 and a fair value of $59,000. The remaining useful life of this plant at acquisition is 50 months. Important to note that for the group, the accounting policy in terms of IAS 16, your PPE, will be at cost. And then goodwill, we give you the goodwill amounted to $10,000, but that is now without the remeasurement of plant. NCIs at proportionate share, and then there's our exchange rates. On 1 April 2016, that will be our acquisition date. And then on 30 June, that is our year end. And then we also have the average for the year. Another couple of background to the question. The CFO have asked Grace, she is the accountant, a couple of questions per email regarding the translation of the foreign subsidiary. So the first question he asked, what effect will the fair value adjustment on the plant have on the non-current assets of Haiti Limited that will be recognized at acquisition date? Also, you need to also take into account that the group, you make use of the cost module for PPE. Second question that he asked is what is the subsequent accounting treatment of the initial fair value adjustments on the plant? So just from this, you can already see that this will be a discussion type of question. And actually, we have given you what is the required. We will want to have the answer for what is the effect on the fair value adjustment and what is the subsequent accounting treatment. So when you read this in your reading time, you will already have an idea that that is the required. So let's see, what is the required? Prepare an email on behalf of Grace to CFO in which you address the questions raised. So there was a please note. You don't have to discuss deferred tax discussion. You don't have to discuss the subsequent treatment of goodwill. And please note, you must include calculations or reference to amount in your discussion. Guys, just on this, I see when we mark tests and exams, numerous students that don't look at the please note. The please note is almost the most important part of what is the required, because there we tell you stuff not to do. So don't waste time doing it. If you have journals, for example, we will tell you narrations is required or narrations are not required. I see so many times that students don't read that and waste so much precious and valuable time. And remember, if we waste time, we are effectively wasting marks as well, because you need time to go and score the easy marks in each and every question. You need that almost 10 minutes to quickly do question 1A, that's 7 marks. Okay, so please read this very carefully always. And then also, we don't need to discuss what should happen to goodwill afterwards. Should we test for impairment and all of that stuff? It's not required, so please don't waste time. But in saying that, the key word is here, subsequent. Okay, so initial treatment of goodwill should be discussed, especially what will happen to goodwill if we have to take into account the plant now, the fair value versus the accounting, the carrying amount of that plant. Because we have given you that the goodwill was $10,000 without that remeasurement. So obvious, if we take that now into account, goodwill will change. But that is the initial accounting treatment. So we need to discuss the initial accounting treatment of goodwill in these calculations. And then the last one that is also important is the required set, prepare an email. Okay, so that will usually be a discussion mark or a communication mark, presentation mark, whatever you want to call it. So that will usually be a presentation mark. So please do the email. Okay, do the email format. Don't worry about the nitty-gritty of writing the email address in brackets and blah, blah, blah. Just do a quick email to blah, from blah, and the heading, and then write your discussion. So what was the first issue here? The first issue is, what effect will the fair value adjustment on the plant have on the non-controlling interest at acquisition date if the group made use of the cost module? So what is important here? We are at acquisition date. So what standard affects the acquisition date? That will be our IFRS 3 standard. Okay, what is the issue there? Should we or should we not fair value our PPE, that plant? Okay, and then the second one is that we have to discuss goodwill, because if all of a sudden we have that new remeasurement, we also need to discuss goodwill and how it will change. So let's see, here's the answer. So what happens? Can you see, guys? There's my email type of a heading. So there we will have a presentation mark. So as we said, we will discuss your IFRS 3. So there we discuss that the fair value of our assets, liabilities should be at fair value or recognized at fair value. Despite of the fact that the group are making use of the cost module, IFRS 3 overrules IAS 16, so we do it at fair value. So the plant should be measured at 59,000 times your at acquisition rate, and then what will happen to goodwill? Let's see. Oh, I've made some stuff here and I didn't even use it now. So what will happen to goodwill? Goodwill should also then change. And remember, we don't want to worry about what happened to goodwill afterwards. The fact that goodwill should also be remeasured at each year end. We don't want to do that. We're just worrying what is my effect on goodwill here. Okay, so now my carrying amount have increased of that $6,000. And then goodwill will then decrease. And remember, it will always be at acquisition rates. Let me quickly see. Just on this note, remember now, if we think journals, I'm just now talking about the depreciation of that plant for the years then coming, because remember we have a 50-month remaining useful life on this plant. So just quickly on the journal of the depreciation. So remember, the depreciation and the accumulated depreciation will be at spot rate at that year end for the years to come. Why not the average rate? Because we see it the same as an intercompany group, intercompany transaction. When we have an intercompany transaction, say for instance, we have bought inventory from our parent or the parent bought from the subsidiary. Remember that unrealized profit that we take out at the end of the year, that will also be at the spot rate at year end. The same with your depreciation. Guys, on that note, I know that group statements does it a little bit different. Group statements take the average rate. So there is no black and white in this. The standard doesn't give us an exact answer of what to do. So it's a gray area. We have consulted with other universities and everybody feel we should take the spot rate, okay? But if you use the average rate, you will still receive all the marks applicable to that journal or that calculation of the depreciation. Also, our marking cycle, I'm marking ITC, so I know also there we take both into account. So please don't despair. I would say the more correct answer is the spot rate, but if you forget that for a second in the test or in the exam, average rate is also fine. You won't lose marks. Okay, so that was the first part of the required. Now my second part of the required. What is the subsequent accounting treatment for the fair value adjustments? Okay, so subsequent treatment for the fair value adjustments, again, not the goodwill, only the fair value adjustments. For that, we have to go into our IAS 21. According to IAS 21, we should then, it should be depreciated. Oh, I think I just went ahead of myself in the previous slides, but that's okay. So it should be depreciated in terms of IFRS 16. Assets and liabilities will be translated at the closing rate. Income and expenses will be at your the average rate. But for practical reasons, if we cannot do each on each date, we can take the average rate. So the additional depreciation will also be translated at spot rate or closing rate at 30 June. And then there is also the depreciation. So for this year, we have 3 months. And then we will have the spot rate at 15 Rand 62. So we have a total expense of 5,623 Rand that we will use. So just quickly, just to pull everything together in terms of your foreign exchanges, foreign subs. Remember, your at acquisition assets and liabilities will always stay at the spot rate at acquisition. So when you have to translate your FCTR, you will either receive a trial balance of that foreign subsidiary, or you will get the or you will do it on the analysis method with your equity values. But remember, at acquisition assets and liabilities will always stay at acquisition dates or rates, rather, the equity. The retained earnings mark to market and any revaluations or any OCI items will be at the average rate for that specific year. The current year movement for those mark-to-market revaluations, profit for the year will be at the average rate. If there was dividends declared, it will be at a specific rate. And remember, if you receive the trial balance from that subsidiary, any remeasurements that you might have in terms of the acquisition, like in this question we had that plant that was fairly valued, then those type of remeasurement stuff, you should do that extra. Remember, the subsidiary won't have that fair values adjustment on acquisition in their trial balance. Okay, so we should do that additionally. We should remeasure that fair value each year at year end again. The same with our goodwill. Remember, goodwill is only a figure that is calculated in your group's financial statements. There won't be a fair value, I'm lying, there won't be a goodwill amount on the subsidiary's trial balance. So therefore, goodwill and any other remeasurements should be translated separately each year at the spot rate of year end. Hey guys, any questions on that? Everybody still awake and everybody still happy? Please talk to me.
Yes,
Thank you, that's excellent. I like to hear your voices. Any questions so far? Okay, let's move on. So now we are busy with question 2. This is a quite longer question, so please stop me if I'm going too fast. Guys, in this longer type of questions, I think the key to start reading this longer type of questions is to always start with your additional information. Your additional information, that is that list of information at the end of each question. But that is actually the most important stuff. Because there we will tell you what is the accounting policy of PPE, of investment property. We will tell you how NCI is measured, because then already if you have that information in the background, you can already see when you start with your reading time and there was a new acquisition. You can already start to calculate goodwill, but know that NCI will also have goodwill, because in this case, NCI is held at fair value. Then the third bullet from the bottom, there it says the Arabica Limited Group recognize any difference between the amount by which the non-controlling interests are adjusted and the fair value of the consideration paid or received. That will be directly in a change of ownership. So there's already a clue that somewhere in the scenario, we will have that IFRS 10B96 calculation. We should do that somewhere. So that's all very important already. Then also the second last bullet, where you have the profit for the entities that is incurred evenly. Guys, it's important to note that is either incurred evenly or not, especially with your OCI items, because many of the times, or sometimes I would rather say, mark-to-market movement will happen at a date, okay? Or if you decide to revalue land or whatever the case might be, revaluation can happen on a date. Then you would know, do you have to, now I'm running out of English. Do you have to accrue those revaluation over the time, over the period, or will it only fall in that specific day or on that specific day? So if you acquired a subsidiary during the year, you will know then, oh, remember that revaluation happened only after acquisition. So we don't have to accumulate that for that 3 months, for example, if you have bought that subsidiary in 3 months within the year. Does it make sense? Oh, you see, I've already done some fancy stuff here and then I'm not even using it. Okay, so let's go to the question itself. What I've done is I have just done, instead of just pasting the Word document for you, I have done it in this bits and sorts for you to calc or to read. So read with me. So Arabica is our holding company, and all the companies in the year, the 30 June year end. Grind Roast Limited and Latte is the first subsidiary that we have bought. Okay, so on 1 August 2014, Arabica have acquired a controlling interest of 80% in Grind Roast. Then in that same year, Grind Roast acquired a 45% interest in Latte, and that was a joint venture. Just quickly on this, sometimes I get the question from students that, what happened now if this joint venture, this Latte, will sell inventory to another subsidiary of the Arabica group? How will that affect our journals? Just remember, it won't affect your journal because that other subsidiary will also be consolidated at 100%. So it will be as if that joint venture, this Latte in our example, will sell the goods to the holding company. Because remember that all the subsidiaries are added line for line at 100% at consolidation. Okay, so your journal's entries should be exactly the same as if it was just another holding company. I hope it makes sense. Then quickly, let's see, there were some intergroup transactions between Arabica, Grind Roast, and Latte. Yes, my love.
Can you please repeat that?
Yes, I will. Okay, so the question that I receive from other students is that sometimes a joint venture, say for instance in this case, so this is a joint venture that is very far off, if you understand what I'm saying. So say now for instance this joint venture, this Latte, sold inventory to, I'm going to make a name up, to Coffee Limited. Coffee Limited is also 100% or is a subsidiary of the Arabica group. Okay, remember with subsidiaries, we will include all the TB, their whole TB, line for line at 100% to our consolidated financial statements. Everybody happy with that? Okay, so now if this joint venture, if this Latte now sold to that Coffee Limited, remember, because Coffee Limited is included at 100% line for line in your consolidation, then if there was intergroup transactions, it will be as if the journals will be exactly the same as if this joint venture have sold the goods to our holding company. Okay, because that other subsidiary is consolidated at 100% line for line. Happiness.
Yes,
Sorry,
ma'am.
ma'am.
Thank
Yes.
you.
Okay, no problem. Is there any other questions on that?
Okay, ma'am. Just a supplementary question. So,
Yes.
okay, maybe that we assume as if the sale happened between the parent and the ASO. Okay.
Yes.
So, since we consolidating a subsidiary 100% from the team, so
That's it.
in that they will be, let's say they've already done their consolidation, like they've consolidated their statements. So now we take line by line 100%. So what about, let's say maybe since the transaction happened between an ASOC as well as a parent like a subsidiary. So
Yes.
as a parent of that subsidiary, we're going to take the line item of the investment in ASOC as well as a share of profit. Then we take 100% into our books. So why shall we pass journals or?
Just remember that an ASOC is not 100% consolidated. An ASOC or a joint venture in this case will only be represented on your consolidated financial statements by your 3 line items. By your line item in the balance sheet, it will be represented by your investment in associates. In your income statement, it will be represented by your share of profit of associates. And if you have any OCI items, it will also be represented by that share of OCI of your associate. So remember, if you have an associate, we do not consolidate 100% line for line that associate into the group's books. We do the equity accounting. And what is equity accounting again? Remember, you will just bring into account what is your percentage. So if we have, say for instance, this joint venture had a profit for the year of 2 million, we will only bring in 45% of that 2 million into the consolidations books as your line item share of profit in associate. Does that answer your question?
Yes.
Okay,
Sorry.
perfect.
Thank you.
No problem. Okay, so let's quickly go on here. So during the year, it said to us that intergroup transactions between Arabica and Grind Roast and Latte there was some intergroup transactions. So there was the intergroup transactions. So Arabica purchased equipment from Grind Roast on 1 August 2014, and Latte purchased equipment from Grind Roast on 1 December 2016. Then Grind Roast have a markup of 25% on cost, and your equipment have another useful life of 4 years from the date of purchase. And then just to let you know that these equipment that was bought is still equipment in our PPE. Okay, so let's see what happened. Okay, so that is our first company that we have. The second company that we have's name is Roasting Bean. What happened there? So Arabica also acquired a 75% controlling interest on 1 June 2015 for an amount of 555,000 Rand. And there we gave the equity on 1 June 2016. 15. We also tell you that all the assets and liabilities are deemed to be fairly valued, and there were no new assets or liabilities identified. Fair value of NCI is at 190. Remember, why do we give the fair value of NCI? Because remember, NCI, according to our additional information, NCI is held at 190,000. NCI is measured at fair value. I'm so sorry. Then we also give you that the profit after tax for the year was 146. Remember now, our year end is June 2015. we have bought this on 1 June 2015. So we have bought this 1 month before year end. Okay. Then on 1 January 2015, so that is way before there was a subsidiary, Roasting Beans acquired land for 1.1 million. That was also the fair value on 1 January. The land was rented to Arabica since then, and then the fair value was the same for this land on 1 June on acquisition date. So there was no change in fair value for this land specifically. Land was investing property in the books of Roasting Beans. Roasting Beans also recognized an increase of 210,000 on 1 June 2016. So this is in the new financial year. Okay, we have the increase, and then there was rent paid. So just quickly here, just remember that in Roasting Beans, so in the subsidiaries books, it is an investment property. Okay, so any fair value adjustments, all of that stuff have to go through profit or loss as a fair value adjustment. Okay, no depreciation. But since 1 June 2015, when there is now a subsidiary holding company, what's the word in English? There's now this, no, I can't think now today. But anyway, there's a holding company, a subsidiary thing now. So now all of a sudden, Arabica uses this land as PPE, as owner occupied. So what does IFRS 16 and ERS 40 tells us? It tells us that as soon as we are in a consolidated environment where the holding company leases investment property to the one company, leases it now as owner occupied, then Groups tells us that we have to change that into a IFRS 16 land. Okay, so what will happen on, so let's start first. What happened on in the groups, in the books of the separate financial statements of Roasting Beans? So as I said earlier, that is the investment property. It's held at fair value, and there was a fair value increase of 210. Remember, the fair value increase will be at CGT rates. But what happened now in the groups books? In the groups books, all of a sudden it is now PPE. Okay, so now in the groups books, we will have to go and reverse that 210,000 fair value adjustment, because in the groups books, it is now a PPE asset and not an investment property anymore. So just look out for that. What will happen to the 180? Remember, the 180, it will be an intergroup transaction between the parent and the subsidiary, so that will be eliminated at group financial statements. Any questions?
Oh, okay, ma'am. The question, let's say, since the parent is at a subsidiary sitting as the investment property, the group will take it back to PPE. So let's say we're doing change in news. Let's say we're doing like we are moving from investment property to PPE in IFRS. So yes. we can't apply the same principle, or maybe we just, I'm not sure, maybe we eliminate.
Oh, you're talking now FAC 4863.
Yes, in FAC 4863, like when we're moving, like we're taking the investment property to PPE. Anyway, we take the fair value on that date of change,
and that will be your deemed, that will most be your deemed cost price going forward in PPE. Yes.
Yes.
So in groups, we don't change that. Okay. So in groups, we don't change the fair value, or we don't change the actual PPE amount. Okay, we just reversed the fair value adjustment because it is now for groups purposes, it will be a PPE. But remember that that subsidiary, their financial statements, it still shows as investment property. Okay, because it's still in their statements, it's still a piece of land that they have to have capital appreciation or have interest or rent income on. So for roasting beans in their financial statements, it's still an investment property because the definition of investment property is still fulfilled in their financial statements. It is only at year end when we do the consolidated financial statements that we will sort of change, because remember the group itself says that, let me quickly go back. Here we say that the accounting policy for Arabica Limited Group, so for the group it will be cost module, and for land it will be revaluation model. So what does that tell us now? So this piece of land that was the investment property and that is still the investment property in the separate financial statements of roasting beans, that's fine, it should stay there. But when the moment when we get to group's financial statements, it will be now PPE. And what does the accounting policy of the group tells us? That land will be now at revaluation. So effectively what we will do is we will just take the fair value adjustment of the investment property that lies now in other income. We will take that to OCI because the land will be held at revaluation. So that 210,000 still stays, but now it's a revaluation instead of a fair value adjustment in your other income. Does it make sense?
Yes, it makes sense, ma'am. Thank you.
Perfect. No problem. Okay, so let's go on here. So where were we? So we were there. Okay, so the orange block, everybody's happy with that one, né? Okay. And now the bad news. Arabica disposed of a 15% on roasting bean on 30 June 2016 for 185, but we still have control. So this is where that paragraph in the additional information comes in, is to say if there's a B96, we will have to make use of a totally new column in our statement of changes in equity called your change in ownership. Why do we say that specifically for you? Is because the standard just says that that difference between the consideration received or paid and the fair value, not the fair value, and the amount how NCI have changed, that difference, the standard says that difference can go to equity. Okay, so again, the standard is not very clear where it must go. It's clear about it must go to equity, so it must go in your statement of changes in equity. Okay, but not which column. So it can maybe go to your share capital column. It can go to your retained earnings column. It can go to any column, but now when we give that additional information, we tell you, please create a whole new column for this change and call it the change of ownership column, so that we can see, also you can read, but also that there was a change in ownership with this roasting bean subsidiary. Okay. Then there's another company called Coffee Limited. So Arabica acquired a 40% interest on 1 June 2015 for 430,000 that have significant influence. What does significant influence tells us? Significant influence tells us we are now busy with an associate. What is an associate? How does we work with an associate? Remember, associates will be accounted for by equity accounting. So what is equity accounting again, just in plain simple English? We start off with our cost price. Then we add, if we have purchased this associate in previous years, we will add 40% of the retained earnings of prior year, 40% of mark-to-market prior year, 40% of revaluation in the prior year, okay? We will add also 40% of the current year's profit, 40% of the current year's mark-to-market or revaluation or whatever this associate might have. And then we are going to, if there was a dividend paid, we're also going to deduct that from our investment, and that is basically the equity method. So here we also tell you that on 1 June 2015, there's my equity. Okay, so in this company, we have share capital, retained earnings, and revaluation. Okay, we also tell you that all the assets and liabilities were due to be fairly valued, except for allowance for credit losses. The fair value of the allowances for credit losses is 15,000 more than the carrying amount, but that realized on 30 June 2015. So that will have an effect on our opening balances for our current financial year. So the profit after tax for the previous year was 164. Okay, again, can you see that we have purchased this coffee limited also only 1 month before financial year end? Just take that into consideration. And then here we say that Coffee Limited have recognized a mark-to-market gain on investments of 10,800 on 1 September 2015. So that's what I talked about earlier. In this case, all the normal profit, that 164, that we must attribute between and after acquisition. Okay, but for the mark-to-market, it happened on a specific date. So we must treat it. We cannot even it out during the year, only on a specific date. Then further on, Arabica also acquired an additional 15% in coffee for 45, and now we have control. So just quickly on this, I just quickly want to recap that 104 in this regard. Remember what happened in this with Coffee Limited. We have, in the first half of the year, we had an associate. So we will do equity accounting. Then something happened on 1 October. What happened? We control now. Okay, so we have control now of Coffee. But what does IFRS IFRS 10 tells us? What must we do there? Okay, so remember that for the first half of the year, or for the first portion of the year, we had an investment, and that investment was held at equity accounting. Okay, now all of a sudden we will have an investment at cost. Because we have now control, we now falls back into IFRS 3. What does IFRS 3 tells us? Everything must be at fair value. So now we will have to go and fair value that investment in associate first, before we can go on with the acquisition of this new type of investment, this subsidiary investment. How will we know what the fair value amount must be? Well, as I said earlier, what is equity accounting? Equity accounting is you start off with your cost price, plus all the 40% of the previous year retained earnings and all of those reserves, plus 40% of your profit for the year while it was still an associate, minus any dividends received. So that will be the carrying amount of my investment in associate. Okay, so now we'll have to see what is my fair value of this investment. We have now the investment, we have now the carrying amount of that investment. Okay, Now we have to see what information does it gives us, what will be the fair value. What will happen with that difference between the fair value and your carrying amount? IAS 28 tells us that that difference between your between your fair value and your carrying amount must go to your profit or loss statement, either as a gain or as a loss, but it must go to profit or loss. So let's see what other information it gives us. So on 1 October, when we have now gained control, we are back into IFRS 3. Remember, we must search for the fair values. So in this case, we say that all the assets and liabilities were deemed to be fairly valued except for equipment. And then we have the fair value versus our carrying amount. No additional assets or liabilities or contingent liabilities were identified. The fair value of our NCI on 1 October was 187, and the fair value of our previous remaining interest was 182. Okay, so there's the fair value that we must compare against the carrying amount of my investment in associate. Again, what is the investment in associate? How will we calculate the carrying amount? We will take the cost price, the original cost price, plus the share of previous year's reserves, for example, your retained earnings, your mark to market or revaluation, whatever reserves you might have, plus the current year's profit or loss for that portion of the period while it was still associate, the 40% of that. If there was any dividends declared by the associate in that period, we will deduct the dividend, and that is my carrying amount. So whatever that amount is, we will compare against the 182,900, and that gain or loss must go to profit or loss. Let's see, there's some additional information that was also given. Arabica had a profit, there was dividends declared on 29 June, and they had a mark to market. There's grind roast, latte, roasting beef, and coffee. I hope you have your tablet in front of you so that you can refer back to the amounts when we get to the solution. Just a quick timeline. Guys, you don't have to do a timeline, but I always use a timeline, especially in a question like this, where there's so many different companies, that I like to use a timeline so that I can just make sure I'm getting where I should get. So let's see what happened first. So if we have a timeline just for the 2 years, we have a grind roast on 1 August, 80%, and Arabica have bought equipment from grind roast. So just for my depreciation calculation, I know that there's 11 months till the end of that year. Then also grind roast have now the latte on 1 December 2014. There's the latte, the joint venture. And then also just a reminder that latte have bought equipment from grind roast of 16,000. And for them, there's a 7 month until year end for the depreciation. Then on 1 June 2015, again, the 75% of roasting beans. And then we just have a quick summary. The equity was 714, the profit for the year. Remember, that is the profit for the full year. So what must we do with that 146? We must go and split it up before acquisition, after acquisition. Okay, so we will split it up for 1 month, that 146 for that period, for that June period, basically. Then on the same date, we have purchased coffee, which is an associate, for 40%. Then the orange is now related to coffee. So coffee had on 1 September, we had a mark-to-market gain of 10,800 after tax. Remember, mark-to-market will always be at CGT rate. So that is after the CGT rates. Okay, on 1 October, we have bought this additional 15% interest, and the NCI is at 187, and the remaining or the previous held 40%, the fair value was 182. Then remember that investment property thing. So on 1 June 2016, there was a fair value adjustment in the separate books of roasting bean for that investment property. Oh, sorry, I see property is spelled wrongly. I apologize for that. Of 210. But what will happen in the group? In the group, it will treat it as PPE. What is the policy of that PPE in the group? Land will be held at revaluation. Okay, and then on 30 June, the last day of the year, roasting bean, we have disposed of 15% of roasting bean. So that's just a quick summary so that I know I can get my bearings. I know where is what. Try it. If it works for you, it works for you. If it don't work for you, please don't change your method of studying. Okay, this is just how I do it. It's easier for me to see it like this. If it's not your method, please don't change it for now. Okay, so what is the required? Part A tells us prepare the pro forma consolidation journal entry for the intergroup between grind roast and latte. So you see, we only need the journal entries between the subsidiary and the joint venture. We don't want now the journals for Arabica. So please don't give it to us now. Okay, you will waste time if you try to do that now. So sorry, just to go back. No effects on NCI as a result are required. Just a quick one. Will there be any NCI in this subsidiary and latte, the joint venture transaction? Remember, latte is a joint venture, so we won't have anyway NCI. Okay, general narrations are required, so you will get marks for your narrations. And you need to do your deferred tax as well. Okay. So just quickly, just a recap on Tat 102, quickly on your transactions with associates or joint ventures. Remember, the moment when I say associate, I also mean a joint venture, because if you have if you have classified the arrangement as a joint venture, then IFRS 11 tells us you must go now to IAS 28 and do equity accounting. Okay, so the moment when I talk about an associate, I'm automatically also including a joint venture in here. So let's see. Grind roast, which is the parent in this case, have a 45% interest in a JV, in which is latte. So grind roast have sold some items to latte. Okay. So when we have transactions with associates or joint venture, there's two questions that you must ask, and that will help you tremendously amount of how to do the journals. So the first question that you must ask is, where is the profit? In this case, the profit is with grind roast. If we look at the consolidation, we will bring in grind roast into the group's books because it's subsidiary. It is held, it will, or not held, but it will be consolidated at 100%. Okay, so yes, we will bring grind roast revenue, cost of sales, all of those items, we will bring it into the books. Second question is, where is the asset? Will it be an inventory? Will it be a PPE asset? Any asset? Where is the asset? The asset is in Latte's books. Latte is the joint venture or associate. So will we bring in the assets of the joint venture into our books? If I say our books, I mean into the group's books. So the answer is no. we will only bring into account that 3 line items. So if we must bring in something about the balance sheet, we will bring it in by means of your investment in associate line item. If we need to bring in something in the profit or loss statement, we will bring it into the books by means of your share of profit of associate or joint venture. And if we have an OCI item, we will bring it into the books, into the consolidated books by means of your share of OCI of your associate or your joint venture. So what will be my journal on the date of sale? Okay. The revenue and cost of sales, that relates to grind roast because he is the seller. So, and we do bring in grind roast books into the group's financial statements. So we will have revenue and cost of sales. The credit investment in joint ventures, remember what should have been there if it was a sub to sub sale? It will be your inventory. But remember, the JV, we don't bring into the consolidated books the line item of inventory into the group's books. What do we bring? Inventories in the balance sheet. So we will bring in the line item investment in joint venture. Just on the calculation, we remember it was a markup of 25% on cost. So there's the 25 over 125. And only our share, which is the 45%. And then also remember, what did the required say? Deferred tax is also important. Any question on this journal? This is now only on the date of sale. Remember, the sale happened in the previous financial year. So what will happen now in the current financial year? Remember, so because consolidation or group's financial statements rather take place every year from scratch, we need first to bring in the unrealized profit, and then we must realize it because remember, we have sold it. Okay, why do we bring in the unrealized profit first? Because otherwise our opening balances won't be comparable to the closing balances of last year. So we need to bring in the unrealized profit first. So again, my questions, where is the profit? Okay, the profit is with grind roast. Okay, so we'll need to bring in the grind roast. Where is the profit? Where is the asset? The asset will be with latte. In this case, we sold equipment. So what do we know about equipment? Okay, equipment is not like inventory where you realized it within 12 months because it is a current asset that needs to be turned around. Equipment is long term. So how do we realize the unrealized cost of equipment? We realize it by means of depreciation. So the same questions apply. Where is the profit? Where is the asset? So what is my journal? Remember now at this stage that the asset is with the joint venture and we have brought it in by means of your investment in joint venture line item. So what will be a normal journal entry is we will debit your accumulated depreciation and we will credit depreciation. The accumulated depreciation will be with the joint venture. Do we bring in accumulated depreciation of the joint venture line item into our books? No, we don't. So therefore, we should replace it with the line item investment in joint venture. The other line item is then depreciation. Do we bring in the depreciation of the line item in grind roast? Yes, we do, because grind roast is the subsidiary. We will add 100% of their trial balance line by line into our consolidation and then the income tax on that. Any question on this? So this is just a really quick a recap of your TUT 102. Okay, so what will be the intergroup transactions for this year? Because remember, we need to give the journals for the current year. The reason why I've done this is just to show you how it will look in the previous year or on the date that it happened. Because sometimes it's then easier for me to, from there on, to go to creating or bringing in the unrealized profit in the opening balances. So remember, revenue and cost of sales and income tax expense from this journal will go to your retained earnings at year end. And then the balance sheet items will stay. The same with this. At year end, the depreciation, the income tax expense will close off against your retained earnings, and the balance sheet item stays the same. So there's my retained earnings balance, my deferred tax, which is my a balance sheet item, and my investment in joint venture. So there's the 1440. If you look at the investment in joint venture of journal 1, so there's the 16,000 is the total amount that they paid. Take out the unrealized profit. 45% is just our portion of the joint venture. And there's already the 7 months. So in that J1, we have done the previous 2 journals already. Okay, so that is just to bring in my opening balance, to correct my opening balance. Then J2 and J3, this is the current year's depreciation and deferred tax that we need to take into account, because now the equipment is being used, so the equipment is being realized. The unrealized profit is being realized. Any question on part A? Okay, let's go to part B.
Sorry, ma'am.
Yes, my love.
Because ma'am, can you please repeat the first journal?
Journal 1.
Confused. I don't understand. Yes.
Okay, let's quickly go. Do you understand these slides that I'm showing now?
So is this journal revenue? Is it for who grind?
Yeah, the revenue and the cost of sales, because grind roast is the manufacturing of this equipment. Okay, so for them, it's normal business. So therefore, it's revenue and cost of sales. Okay, remember now this journal in the pinkish reddish block. That is just to show you what will be the journal on the date when they have bought this equipment. Okay, so this is just to show you basically. So what I said earlier is that revenue and cost of sales and depreciation and your income tax expense. Remember, when your year closes off, where will that items go to? It will go to your retained earnings, because your profit or loss for the year, where does your profit and loss for the year goes? It goes to your retained earnings column in your statement of change in equity. Happy about that?
Yes, ma'am, I am.
Okay, so basically, what will be retained earnings? It will be your 7,200 of revenue, less your 5,760 of cost of sales, less your income tax of 403 Rand, okay? Plus, also less your 210 of depreciation, because remember, this depreciation for 7 months of last year, that equipment was also used. Okay, so for 7 months of last year, there was depreciation also. So you will less the 210 plus your 60 Rand of your income tax expense. So all of this together will be your retained earnings of 886. Okay, so that 886 is basically your unrealized profit less that 7 months of depreciation that it already realized for that 7 months of last year. Okay.
Yes, ma'am.
Are you more clear now? If you're not clear, we can, and I want to extend this invite. If there's something that you want to discuss, you are more than welcome to arrange a Teams meeting with me, and then we can also discuss stuff one-on-one. If there's anything that bothers you about anything of our syllabus. Okay. And I want to
Thank you, ma'am.
extend, no problem. I want to extend that to any other lecturer as well. Because I know some students have I don't want to say favorite, but have a lecturer that they, that they connect with. So if there's anybody, if you want to schedule a meeting with Malu or Tehu or Herman or Carmen, please, you are more than welcome to do that. Okay, so let's go to part B. So now they say prepare the changes in ownership in subsidiary schedule in the notes. Okay, so here is now where it comes in that we have to go to that specific subsidiary where we have sold a portion of our control. We haven't lost control, but we sold a portion of our interests. Okay, so which company was that again? It was Roasting Beans. We had a 75% interest on 1 June, and we sold a 15% interest a year later. Okay, so let's see what does IFRS 12, because remember in your in the scenario, or not in the scenario, in the require it says you must do it in accordance to IFRS 12 paragraph 18. So what does paragraph 18 tells us? Paragraph 18 tells us an entity shall present a schedule that shows effects on the equity attributable, oh, that's a nasty word, to owners of the parent. And what does the additional information say? The additional information tells us it must be posted directly in a change of ownership reserve column. Okay, so IFRS 12 says that we must post it in a change of in equity. Okay, but our additional information say we are just defining it some further. Okay, so in the additional information we say yes in equity, but in a whole new column. What does B96 tells us? Because we know we are now busy with a partial disposal. IFRS 10 B96 tells us we have to take the change in your non-controlling interest. We have to compare that with the consideration received or paid, and then we'll have that difference. Just quickly on this, guys, I know I'm jumping the gun maybe. And the reason when I'm saying this is because I always make that mistake. When you have a B96 situation in a cash flow situation, IAS 7 says that this kind of where you have just a change in ownership, which is an equity kind of transaction, that change in ownership equity must go to your financing activities and not your investing activities. And the reason when I'm saying it to you is just, like I say, I usually just, I'm almost going to say trigger happy, and just anything to do with investments, I just put under your investment activities. But IAS 7 is clear on this to say it must go to your financing activities. Just a side note. Okay, so just to refresh you quickly, so there's Roasting Beans for 550. We have share capital, retained earnings, mark to market, and all of those. So at acquisition was 714. There's a fair value of 190, a profit after tax just for that 1 month that we have to go and split up for that 1 month of 146. Then we have the investment property issue, investment property versus PPE issue, And there we tell you that the proceeds that we received when we sold this 15,000 or 15% was 185. So there's the one part of the sum. So now the other part of the sum is now we must go and calculate how did NCI change. So just on the analysis, so the top part at acquisition part, nothing funny there. We gave you the 5,000 that they've paid. We gave you the NCI fair value at acquisition. So there's a goodwill of 31,000. Remember, NCI is also held at fair value, meaning they also share in goodwill. For the opening balances, the retained earnings, the 146, as I said, only 1 month. So we have to divide that by 12 to get your 1 month of profit. Then the profit for the current year. Can you see there now we take out the 210,000 fair value adjustment of the investment property. Remember, it is still the policy of the separate financial statements of roasting beans. It is still an investment property. Nothing changed there. Okay, so in the separate financial statements, it will still lie in other income a fair value adjustment. But now when you go to groups, now the policy is not investment property anymore. The policy is now PPE, which is at revaluation, which is held at revaluation. Revaluation is not at other income. Revaluation is held at OCI. So therefore, we take out the 210,000. Okay. You will see also the other comprehensive income. There's my revaluation now of the land of 210. Everybody still happy? Okay. In the information we gave you, there was a mark-to-market reserve for roasting beans, and there was a dividend paid for roasting beans. Okay, so then we get to our figures. So the total NAV is 1179359. Okay, and NCI's amount is 298,590. So how will we calculate this change in ownership of our NCI? Just to recap, the NAV on the analysis, as I just gave it to you there, is that 1179359, okay, less the goodwill of 31,000. So our NAV without goodwill is the 1148. Why do I bother to take out the goodwill in this calculation? Remember that most of the times goodwill is not 100% proportionate in terms of the shareholding. Okay, in this case, the parent have 75% and NCI have 25%, but the goodwill is not, that 31 is not split 75, 25%. Okay, therefore we need to take out the goodwill and we need to work without the goodwill. So let's see, how will we calculate the goodwill of the 15%? Remember now, our parent have disposed of the 15%. So this means that NCI will increase with the 15%. So it will go from 25% interest to a 40%. So my NAV without goodwill will be now at 40%. So there's the 459,344. NCI is held at fair value, meaning it will share in goodwill. So we have calculated what is the NCI's goodwill of 11,500. But now, because we are shuffling reserves, we also need to take in give of the parent's goodwill to the NCI. Note that the 31, the total goodwill, don't change. The total goodwill will always stay 31,000, except if there is an impairment loss. Okay, the 31 will stay, but just the proportionate share between the two entities, I would say, or the two between the two shareholders will change. Okay, so we give a parent a portion of the parent's goodwill also to the NCI. So there's my NCI then after the change, the 474. NCI before the change, we have given it, or not given it, but we have calculated it in our analysis of the 298. So there's my change in in NCI of 176. What was the fair value again? Or not the fair value, what was the proceeds that we received? We received 185,000. Okay, so can you see that NCI must be credited because NCI have now increased. Okay, roasting beans, the investment in roasting beans of 185, and then the difference is my change of ownership, a debit amount. So that debit amount will go then to my change in ownership column in my statement of changes in equity. I just quickly want to ask a question of why do we debit the investment in roasting beans? Is the investment in roasting beans going to get or going to be increased? Remember what happened in the separate financial statements of the parent of Arabica when we sold. Okay, so just think about it. When we have sold that 15%, my journal would be debit bank because I received 185,000. But what will I credit? Remember, an investment is like any other asset. Okay, so it reduced. So we will credit my investment. But what happened at consolidation level? Remember, it's still a subsidiary. It is still 100% consolidated. So therefore, we need to debit our investment in roasting beans in the group's financial statements to get our investment so that we can eliminate our investment at elimination. Our main elimination journal entry. Does it make sense? So just how does it look? How does IFRS 12 says it must look? So IFRS 12 says we must show what is the fair value of the consideration received. We must show how NCI have changed. In this case, NCI have changed or increased rather. And what is the change of ownership? Any question on this? Okay. Let's go to the last part of our question. The last part of our question is to prepare the consolidated statement of profit or loss and other comprehensive income for the year. We have elected to present a single profit or loss and other comprehensive incomes in terms of function, in terms of IAS 1, paragraph 99. And your other comprehensive income should be stated net of tax according to IAS 1, paragraph 91. Your answers should start with profit for the year. So I think this immediately makes it difficult for students because now all of a sudden the profit for the year will be a big calculation. So therefore it makes it immediately difficult. But remember, it's actually, you just stick with what you have. Okay, you have the profits for the year that was given in the information. Then you must adjust it by the information given. With what, for example? Well, there was dividends received from your subsidiaries. Adjust that. There was depreciation for the equipment bought from grind roast. There was fair value adjustments that is not investment property or in the group, so we have to take that out. Okay, so it's small stuff like that that's still applicable as if it was a normal calculation, but we see that the moment we say start with profit for the year, then some wheels come off and students don't know what to do. So just remain calm and you work with what you have. Okay, so where do we start? Just to quickly, just to give you all the information again, Arabica is a holding company, Grand Rose is a subsidiary, Latte is a joint venture that start off of a sub, okay? But that doesn't matter too much because we know that the subsidiary will also be calculated or consolidated at 100%. Roasting Bean is a subsidiary. Coffee is also, or it was an associate, but it's now a subsidiary. I think it will be best to start off with Arabica. So what will influence Arabica's profit? As I said previously, there was some intercompany dividends that we have to should eliminate. Remember, while coffee was an associate, we will have your share of profit in there. That gain or loss with coffee. Remember when I said that in the year we had investment in an associate, then we must calculate what is the carrying amount of that investment. We must compare that towards the fair value of that investment, and that change, or that difference rather, will have to go to your profit or loss. And remember, in the separate financial statements of Roasting Bean, we have disposed of an asset. So there probably, we will have to go and see, there might be profit or loss in the separate financial statements when we dispose of that 15%, that we also have to go and must eliminate in the group's financial statements. Okay, so there's just a screenshot of everything that happened with coffee, because we want to go and calculate what is that fair value adjustment of coffee, which is the associate. We want to go and quickly, what is that calculation? So just on coffee, so the first one that I just want to draw your attention on, if you look at top at acquisition, there is the allowance for credit losses that we have to put in, okay? If we still had to do the previous financial year, remember that excess will also be a part of your share of profit, okay? Just a side note. And then there we, at the since acquisition until the beginning of the current year, there we realized that 4,200 deferred tax and that 15,000 allowance for credit losses. Okay, for the current year, before the additional interest, we have the profit for the year that is apportionate for 3 months only, and there's that mark to market. Why is that mark to market there? Because remember, on 1 September 2015, there was a mark to market adjustment. So therefore, the 10,000 there. Okay, then we have the additional adjustment, or additional interest rather. So in the additional interest, we see, so just to draw your attention, what will be my my carrying amount of my investment? So it will be the 130,000 that we have paid, plus my 10,280 of the excess, plus my 35,907 if you look at the since column just before the additional interest. So those three together will then be my my carrying amount. We will calculate that, and then we will also then compare that to that fair value amount. I think it's 182,900 if I'm not mistaken. We will compare that then, yeah, there's the 182,900. So that difference between the 176 and the 182, that will then be a fair value adjustment on the investment of associate going to the gains and losses, your P&L. Okay, in the additional information, we also said that the additional interest, there was some equipment that was remeasured because of IFRS 3. So we have that new equipment. And then we have a gain on bargain purchase. Remember, a gain on bargain purchase is also a other income. So that will also have an effect on Arabica's profit for the year that was given. Then for the current year, after now we have given that is then that the last circle, the 89 and the 21, that is then a profit while it was a subsidiary. So if we look at the profit for Arabica, we have given you the 849. There's the 21,000 while coffee was still an associate. The 6,700, that is that gain or loss when coffee become a subsidiary, where we compare the carrying amount of your investment in associate with the fair value at that date when it becomes a subsidiary. There's the gain and bargain purchase when coffee becomes a subsidiary. There's my intergroup dividends that we received from from coffee at year-end, because remember at year-end coffee is now a subsidiary, and then also my other subsidiaries. And then the very last line item, there is when in the separate financial statements, when the separate financial statements of Arabica, when we sold that 15% of roasting beans in the separate financial statements, we made a profit, okay? But for group statements, it wasn't a profit, it was only a change of ownership. So therefore, in the group, we'll have to go and reverse that. Okay, so the adjusted profit for the year for Arabica is then 748,860. Let's look at grind roast. So we have given you the 580. Remember, for the equipment that was sold to Arabica and sold to the joint venture, the profit and loss are with grind roast. Okay, so we need to take out that eliminations. You can see the last two line items. There we bring in the depreciation of those where the unrealized profit is being realized. Then Latte also declared a dividend. Who is Latte again? Latte is the joint venture of grind roast. And there's my share of profit of the Latte of the joint venture. So the amended profit for the year of grind roast is then 686,845. Let's go to another, the second last sub. In this case, it is roasting beans. So there's my profit of the 471 less the 210. What is the 210 again? The 210 is the investment property, the fair value gain on the investment property, but for groups, it is a revaluation. Then the profit for the year of Kofi Limited, it is only a subsidiary for 9 months of the year, so therefore we apportioned the 218 for the 9 months. Now just to bring everything together, your Arabica, grind roast, roasting bean and coffee. So there's a profit, a total profit after tax for 1.9 million. So now we are almost there, but what about the OCI part? So the OCI, we remember the required set, it must be presented net of tax. So there we have the revaluation, that is that investment property that will now be a PPE for the group. So there's that 210 after tax, after your deferred tax of CGT. Mark to market, it was Arabicas and roasting beans. And then, or remember, Kofi had that 10,800 mark to market that happened on a specific date. So, and that date was when Kofi was still an associate, and therefore we have the share of OCI while Kofi was still an associate. So there's just to take it together. So there's my profit for the year that we calculated. My OCI items, there's the land, the revaluation of the land, the mark to market, and then my share of profit. Sorry, what I didn't mention before is in the required, it also stated that we don't need to take into account the split between NCI and the parent. So therefore, don't even bother to worry about the NCI because it was not required. Sorry, that was a very important thing that I missed, that I didn't mention. That's that. Thank you so much, guys, for bearing with me. Thank you for listening to me. Let me see if I can help anybody else. Is there, let me see what is on the, okay, so no extra questions. So yes, thank you so much for the inputs that you gave. Thank you so much for the participation. It's always nice to have that participation of students. But please note that, yeah, we are there for you. Good luck for the exam. Please make use of our emails that you can email us if you have anything. Okay, have a good day, guys, and have a good day. Goodbye.
Thank you, ma'am. And please, ma'am, can you just upload the slides, please?
I will.